Hey traders, we're here Friday at last. A long time coming, a busy week again, but we've made it through. Well, just about, a bit more to go. Morning Kate, morning Stel, you surviving?
Good morning.
Good morning.
How are we doing?
We are doing well. Well, I am.
Good.
Fully
That's what I like to hear.
summer weather here, so I'm very, very well.
Yeah. How was your drive yesterday?
7+ hours. It was tiring, but yeah, all good. All good.
Yeah. Have you got to do it again to pick your daughter up?
In 2 weeks' time, yeah. Yeah, it's okay.
You got 2 weeks of peace and quiet. Wow.
Theoretically, last couple of times they were supposed to be away. Both times something happened and we had to pick them up early. So I am not counting my chickens yet.
Oh yeah, well, I hope you do get a bit of peace and quiet, mate. As much as we love our kids, it's nice to have a little break from them now and again.
Yep.
Cool.
How are you,
right.
Ryan?
Yeah, I'm all good, mate. All good. It's Friday. God, been another busy week. Another busy week. I found this week it's been really sort of non-stop during the mornings. By about 2-3 o'clock, I'm pooped. So looking forward to the weekend. Yeah, definitely. Right, let's get stuck into it. A ton of data. It's PMI day around the world. We'll just knock back to yesterday and look at yesterday's data from the US. On the jobs front, initial jobless claims, bit of a nothing number, came in at 264 versus a 260 expected. 4-week average ticking up a bit just on when we saw the moves from around the 230s up to the 260s. Continuing claims, nothing much, a little dip there. So nothing much out of that lot. There was some current account data out as well, but it was Q1, a little bit worse off than expected there. Existing home sales had a little bit of a healthy beat of expectations, coming in at 4.3 million versus 4.25 expected. The prior was revised up a touch as well. On the price front, which is something I'm keeping an eye on, prices were a little bit down on last month, but up. Oh, is that right? Let me see if I can got myself the right rate round. No, sorry, they were a little bit up on last month, but down on last year, same time last year. So May last year they were at 408k, and this May they were 396k. So just a bit softening year on year, but up on last month. No red flags is the main story from that. And we know that Powell mentioned that he expects house prices or price inflation to drop significantly this year. So we're going to be on watch for that one. Eurozone consumer confidence came in surprisingly as a negative, but not as bad. Things are not as crappy in the Eurozone, it seems, coming in at 16.1, minus 16.1 versus minus 17 expected. Overnight, we got some CPI data from Japan, national numbers there. Headline inflation came down to 3.2% from 3.5%, was expected to jump to 4.1%. However, the core numbers beat expectations, coming in at 3.2% versus 3.1% expected, although that was a little bit of a drop. The core, which is not on there, that's the ex-food and energy, ex-fresh food and energy, came in at 4.3%, was beat expectations of 4.2%, and higher than the previous 4.1%. So still in the core numbers, a bit of stickiness going on there. The BOJ still expect inflation to come down, possibly below 2% towards the latter part of this year. However, the clock is ticking. We keep seeing these numbers coming out, and they keep staying above the 2% target. So we're a bit of clock watching here, I think, in Japan for how long inflation stays up versus their expectations. Do you think that might put a little bit of a squeeze on the BOJ if we get to sort of September, October, K, and the numbers are still up there?
Well, that's the thing between Japan and the rest of the world. Ueda was saying that he expects inflation to come down quite rapidly in the second half of their fiscal year. So that means after September.
Yeah, that's true.
Yeah, I think it's really clock watching, as you say, and in the meantime, yen is suffering a little bit less than earlier this week, but still suffering. If you look at it, dollar yen above 143, the market is really on the wagon of lower yen for longer, lower yen rates for longer, especially than the rest of the world. Yeah, I think there's not much to say. And as I said yesterday, after that Noguchi talk as well, I think the only ones really that can put a bit under the yen, and then remains the question for how long is the MOF.
Yeah.
Right now, without interventions, unless we see the rest of those data now starting to come off really rapidly. The US PMIs this afternoon, for instance, unless that really happens and the market is thinking about other countries doing something with their rates to the negative side, it's hard to be long yen. It's very hard.
Yeah. We have had Suzuki out in the last few minutes, just the usual jaw-boning, low-level stuff, saying we're not comment on FX rates and is firmly watching what's going on, but nothing that we should be worried about right now in terms of DEFCON levels for intervention chatter. So that still gives yen a green light to continue weakening if it so wishes. Back to the data, and the PMIs in Japan were out as well. Manufacturing moved into contraction, was expected to rise a bit further into expansion. Services also pulling back a little bit, again was expected to rise but came down to 54.2, and that's a bit of a theme we're seeing across the board this morning. UK retail sales for May were up, better than expected. I'm not sure why we were looking at a negative, because we obviously had the coronation, bank holidays, good weather, so on and so forth, and that gave retail sales a little bit of a boost there. We're not talking anything major here. Up 0.1% in core sales, up 0.3% in headline sales. So we're not talking gangbusters here, but still, positive number is a positive number, and the year-on-year numbers also not as bad as expected. Spanish GDP, these are final numbers, came in a little bit better than expected on the quarter, 0.6%, 4.2% year on year. So no recessionary problems thus far for those guys in Spain. France, manufacturing took a dip in the PMIs. Services went into contraction. So we had been seeing a bit of divergence in the numbers. Now we're seeing both of them going the same way. Germany as well, manufacturing further into contraction, services a bit of a dip there, more than expected. You can see the story playing out in the pan Eurozone numbers there as well. The UK, similar story, further weakness in manufacturing, softening in services. As Kay mentioned, let's see if this rocks into the US numbers as well. I've been seeing a similar pattern in that. You can see from the PMI here, in contraction in manufacturing, but still holding in expansion in services. But are we going to see a weakening across those numbers there? On the central bank front, Turkey wussed out and only hiked rates by a paltry 650 basis points to 15%. They were expected to take rates from 8.5 to 21%. Some even thinking 25%. One could say they took a bit of a cautionary step, only going to 650 points for that one. Turkish lira didn't like it much, and that rocketed to fresh highs. So the market not sensing any calm from there over that side of the world. We'll leave the Bank of England till last, because I know you like to get stuck into that one. On the central bank front, still though, ECB's Nagel said that tight labour market could result in persistent inflation pressures. Rates have not peaked. An eventual peak must be held for an extended period until inflation is broken. For the ECB, and after these PMI numbers, traders have outpriced a peak now of 4% from the ECB, so they expect to peak below 4%. So a lot of those September expectations now washing out of the market since those PMIs showed a bit of weakness. This is we are in it now. We've been talking about it for long enough, how markets are data dependent. Now we're over the central bank price moves and everything to do with that over the last couple of weeks. Today's probably been the first real clear day we've seen in markets what trading data dependency is like. You've only got to look at your euro charts, euro dollar, euro yen, yields, that sort of thing, to see what trading data dependency is going to be like moving forward. Over to those good old Yanks. Fed Bowman says we need additional rate increases to curb inflation. Inflation is still unacceptably high despite the drop in the headline number. Core inflation has essentially plateaued since autumn 2022. Fed Barkin is comfortable with more hikes if inflation is not heading towards the goal. Says he will not prejudge the July meeting though. Powell, day 2 of his testimony. Yesterday, no real differences, although Bloomberg decided that the headlines were a bit too boring, so they wanted to spice up his opening remarks. They printed a headline saying that Fed's Powell says it will be appropriate to hike rates twice more this year, which sounds hawkish on the face of it, nailing down 2 hikes as a definite. However, the true headline from that was that he said that the Fed broadly feels it will be appropriate to raise rates again and perhaps 2 more times. So the market got a little bit of a kick on the Bloomberg comment. Dollar yen was already looking like it was ready to pop, and that just gave it the nudge it needed on that. But again, just shows you how the news wires can play around with the headlines when they feel like it, and it does have an influence on markets. So over we go to the Bank of England, and they went and hiked the 50. So more the hawkish side, probably the top end of hawkish expectations, a hike by 50. All the 7 votes, it was 7-2 vote for hikes, all 7 voted for a 50. So there wasn't even a split between some thinking about a 25. Everyone went for a 50. The 2 usual doves sitting on their perch, looking pretty stupid if you ask me, but that's a personal view, still voting to leave rates unchanged. The BOE said that inflation persistence would require further tightening. Saw significant upside news in recent data that indicated there's going to be more persistent inflation in the UK. The second round effects on domestic wages and prices are likely to take longer to unwind than they did to emerge. The MPC recognises it is important to consider the housing rental market developments. When that comment dropped, I noted it because they didn't mention anything about mortgages. However, they did drop in a line saying that the greater share of fixed rate mortgages means the full impact of bank rate rises will take some time. So a little bit of a bigger nudge towards rentals than mortgages for now. That may be because they see it more as a political issue and they want to keep their hands clean of that one. Now, BOE's Bailey wasn't due to have a press conference, an official press conference, but he saw the need after the 50 pip surprise to go and hit the news wires and TV stations and radio and everything. So he was out not long after saying that inflation is still too high and we've got to deal with it. If we don't raise rates now, it could be worse later. This is from the guy who pretty much said he hoped after the last hike he wouldn't have to hike again. Well, that one got shot to pieces, didn't it? Then he said, along the same lines as Bank of England's Peel, who got in trouble for telling people that they might have to be a bit poorer, says we cannot continue to have the current level of wage increases. which will go down well with those looking for wage increases. And he said, we cannot have companies building profit margins that cause prices to rise at their current rates. So having a pop at firms now as well about making profits, which isn't that what capitalist economies are supposed to do? Boys, work your way through that lot. What did you make of it?
Well, for me, well, we said it right after they did it, and so they did what they had to do, what they should have done already earlier, but they did what they had to do. And to be really honest, we thought that whatever would happen, Bailey would screw it up, and sterling and lower. Okay, we've had a move in the cable, but then the rest of the dollars have been moving as well. If we look at on the cross side, sterling is actually doing pretty well, although not like rising much. Euro sterling is off because of the weaker Euro PMIs, but then stuff like sterling yen, sterling Aussie, and things like that is still holding up pretty well. So they went with sterling is wondering what to do right now. So and to me, I'm in the same camp. We had a plan on the Bank of England, and half an hour later, that plan went kind of out of the window, because we came back to levels where we were before the Bank of England, before the rest of the market started to move. And I'm a little bit in that camp too. I have trouble to see a Bank of England trade. I have trouble to see right now. So they did manage to do what they should have done. That's about my view for now on that.
Yeah, no, exactly. And as I spoke yesterday, that what they did with a 50 is pretty much what they should have done. It doesn't put them ahead of the game, but it puts them level now where they should have been in the first place. They were behind, now they're back to being level. And I think that's going to be more neutral for the pound going forward now. The market was already pricing 6% quite strongly before. That's not changed at all. A lot of the market now, banks up around 5.75, some other aspects of the market around 6%. So on that basis, we are priced. Now it's going to be a question, like everywhere else, does the data conform to that view? Certainly the banks have all ratcheted up their expectations, some looking for another 50 in August, which I think is a bit punchy, but who knows? But yeah, we got the pop in the quid right on the announcement pretty much, and then off it came, as Kay mentioned. Some of that obviously down to the dollar. I guess you didn't really see the Bank of England stuff yesterday still, so I'm not sure if you've got much of an opinion on it.
I was traveling, but I did read up on it, and so the 50 was, I didn't actually expect them to do 50, although, like Kay said, that's really what they needed to do to kind of keep up with the curve. I remain of the opinion that sterling is going to be one of the currencies that keeps outperforming this year on the basis of central bank divergence. And yes, data has not been great in the UK. The same can be said in Eurozone and to the US. So, is the UK doing great, firing on all cylinders? Of course not. But we have wages rising. We have inflation really sticky. I mean, core went up last time on a year-on-year basis. And theoretically, if their mandate is to keep price stability and inflation close to 2%, what can they do? They have to keep hiking 50s, really. I mean, this is really what they have to do to bring inflation back down. Now, they know that with every hike that they do, they're going to be strangling the economy even more. And we've said this so many times, when rates were at 1%, 2%, you can keep hiking. It doesn't become a problem until you get to levels like these, 5-6% rates. That's going to be a problem in the medium term, and they know it. They know that it's going to hit the housing market with all these mortgages, resetting and needing refinancing and all that. And I was speaking to my brother the other day, and yesterday actually. He has a mortgage, an interest-only mortgage on a big chunk of money on a flat he bought in Chelsea back in 2005. It was base rate plus 9 basis points. So basically, he was paying 0 for years and years, but he had an expiry date which is this year. So he's now he's panicking a bit because he's going to be paying 6% or whatever it is or more. So I don't think he's the only one. And so the central bank, they know that they're going to be causing issues with the housing market, with everything. And so they ideally don't want to keep rates high for long. But what can they do? What else can they do to bring inflation down? So I think on the basis that inflation is higher in the UK, and also wages growing at a very decent rate as well, I think that the central bank divergence is going to bring or keep the pound relatively strong.
Yeah, no, I agree with that. I do think we are getting towards the top end of rate expectations. I think maybe we see the Bank of England getting to 5.25%, 5.5%, an outlier 5.75%. But I think that's going to be the very top for where they're going to go. I think the clock is going to be on their side for when they actually see inflation coming back significantly. I'm expecting that in August to happen when we start seeing all this energy stuff rolling off. But again, the flip side, as we've been saying, is the wages issue, which is still there and very persistent, and was mentioned in the PMIs today. Input costs have been falling in the PMIs, but output costs only fell a small bit in comparison, and wage pressures is one of the big drivers of why output prices are still remaining high. So it's definitely still in a rock and a hard place for those guys at the bank, and I think that's going to make trading the pound a little bit more two-way, shall we say, for there. So as we said, cable is it's looking a little bit weaker this morning, depending on where you look. It's looking weaker versus the dollar. And what I did note this morning was that as the PMIs were coming out, pretty much across the whole of the yield space, yields were falling. So US, UK, Europe. That to me suggests we may be seeing a bit more of a risk move in terms of worries about global growth overall, as opposed to jumping between what's happening between one country and the next. So that's a theme we're going to have to look for. If we see the US PMIs doing a similar thing, then I think we're going to see a continuation of global growth worries, and that's going to affect assets, going to affect commodities, so on and so forth, moving forward. Euro sterling, as Kay mentioned, so yeah, euro sterling looks a bit better on the pound front compared to cable, maybe heading towards the prior lows, and a look at the 85s. I've got some bids layered in down here just to play this level from a tech perspective. Been talking about it long enough. It is a pretty decent level, so I'm going to have a little go down there if we see it. I'm not going to put the house on it or anything like that, but it's worth having a look at just as a tech trade down in here into the 85s, down into that zone there. Sterling yen, that's looking like it wants to make new highs and following the rest of the yen trade. As we've mentioned, we're still at low jaw boning from officials, so that's going to keep the move going on there. I think I was looking. I did have some bids in over the BOE yesterday down towards 82s. I thought I might try catch that knife down there. Didn't even get close. So watched the ships sailing away thereafter. It's been a bit of a story in my week. I've had a bit of a frustrating week overall, trading wise. The last couple of weeks, I seem to have the market right and the events right, but the price, I haven't had the price action to go my way to get me into anything. So yeah, a bit of frustration yesterday after all that stuff, knowing that, as I say, knowing I was right on the events, but didn't quite get the moves I wanted. Euro sterling ended up getting out of that short around 86.10 for a small loss, even though it went the right way from the ECB to the BOE, but just didn't at the end. So yeah, just a little bit frustrating, but that's trading for you. One thing that is going right this morning is dollar China. That's breaking up into the 120s. Sorry, 127.20s. So I've moved my stops up this morning. They were down below 709 and now are just above entry at 713. I want to get a move up to this 724s, and then I can start pulling up the stops a bit more behind that. I am looking just to see if we get a move to these back towards these highs, just to take a little snip off my longs, put a bit more in the bank. But this one continues to move on up, and long may it continue. Stel, you got anything you're looking at in particular at the moment? Metals have been a bit soggy. Oh, he might have nipped to the nipped off to for his delivery. Oh, there he is. I don't know if you your doorbell had rung.
No, I'm here. It did ring before. I got one of the 2 deliveries. I have one more left.
Okay. New surfboards are coming thick and fast.
You're looking at silver.
Yeah.
Well, I've been saying for days or maybe even weeks that it was more than 50-50 that we go towards the low 22s, and we are there. I was considering adding to my position at around these levels, but the kind of sheer force and relentlessness, we haven't even had a single day of recovery, right? I mean, there's almost no pullback. It makes me think that this might actually go and head towards 19 now. I'm going to sit and wait. What's interesting is that I shared this in the chat room earlier today. There's an account I follow on Twitter who posts daily the COMEX inventory situation. And it's interesting because for people who don't know, there are 2, the COMEX, basically they have physical silver for delivery, right? Because futures, they correspond to an amount, each contract corresponds to an amount of actual physical delivery if you hold the contract and you take it to delivery, to expiry. Yeah. So there's 2 categories. One, which is called registered, which is basically metal that's been put aside for delivery. So it's been registered for somebody to take delivery of that. And there's the other category, which is called eligible, which is not for delivery, but it's there if needed to be moved to the registered category. And these are 2 numbers that I've been keeping a track of for months now. And the sum of these 2 has been moving lower and lower and lower. I think it's at something like 3 or 4 year lows. But interestingly, we had yesterday, or was it the day before yesterday? I have to check. We had over 5 million ounces moved from eligible to registered, which means somebody is about to take delivery of 5 million ounces plus of the actual physical. And the more this happens, the more the obvious ARB becomes obvious. So you have spot, which is at 22, and you go to any mint. They're selling 1 ounce coins for 30 plus. So this is practically a 50% premium, which doesn't make sense. Usually this premium used to be, 10, 15, 20%. That is kind of understood. At these levels, you can easily, well, theoretically, if you have the cash and you can go forward with it, buy contracts, take them to delivery, take the actual physical and then sell it in the spot market, which in the physical market. So, and you make quite a big profit. So this, just to put an idea on the numbers, this 5 million ounce that moved to registered is about 1/6 of all registered metal. So it's a big chunk. And people are taking notice of this. So, then again, this kind of inefficiency, let's say, has been going on for years, to various degrees, but now it's becoming really big, the difference. So something has got to give. Either the physical starts selling for a lot cheaper, or the futures and the spot starts rising. Good question. But just something to keep in mind, because at the end of the day, all these markets are underpinned by physical. That's what they were built around. Forget the fact that the amount of futures traded are multiples of what is actually produced every year. I remember there was a guy, who mentioned, and I checked it, and this is true. Last week, when we had a really big daily drop in silver, more dollar amount of silver traded in one day on I think it was 7 minutes that it got sold into than is the entire production over a whole year of physical.
Wow.
And that shows you that how this thing is really played around and moved around. Anyway, so price wise, I'm gonna now wait for 19s. We might get there. It's if the dollar starts strengthening, because remember we had this drop here with the dollar doing very little. Okay, strengthened, but not really that much, and yields have actually not gone anywhere. So if yields start rising and the dollar starts rising, you can pretty much bet that metal is going to hit again and again. So this is theoretically a good support here, 22 to 22.50, roughly this range. But what do I think is going to go? Where do you think it's going to go? I think it's still 50-50 that we go towards 19 rather than bouncing higher. So we wait.
Yeah. I don't think those PMIs have been helping an awful lot with the global picture. Manufacturing really taking a hit. That's not good for commodities, whether it's precious metals, copper, oil, you name it. But on the other side, a big drop in commodities also takes away some inflationary pressure. So there's swings and roundabouts to both sides. But interesting knowledge there on silver and the physical side of it. Obviously, as someone coming from the metal exchange, metal markets, I know full well about physical markets. Used to carry around LME warrants worth millions in carrier bags around the city, delivering them. So I know full well about that sort of stuff. I'll tell you some stories about that, I can assure you. Gold as well looks like it's making a break. Everyone was looking down around this 1930s initially, and then we've gone through that, and we've been through the next level just down below, broken out of this, we call it a channel, whatever you want to call it there, short term. We might have the door open now for a move to 1900. We've got a old 38.2 fib coming in at 1894, which has also been a bit of a on-off support and resistance area. So that's somewhere to keep an eye on as well. If we do move down, as mentioned though, it's looking like a commodity blip as opposed to just a metals blip on that. What are you making of the metals, Kay?
Yeah, very interesting story still, by the way. Thank you very much. I'm
a storyteller.
Sorry, mate?
I am a storyteller.
Yeah, I mean, no, it's really good. I mean, it's interesting for everybody. Yeah, the metals are a bit weak. But the way I'm trading them is I'm still I've got a tiny bit on the bid at 22 and then lower in the 21s, because I've let some of mine go in the silver prior. That's now a good while ago in the 24th. So I just want to start to rebuild my my long term, but that's it's kind of a different play, and to me it will still be okay if it goes down to 19. I will load a lot more up there and perhaps go a bit overweight as well. But yeah, for the time being, we can't ignore the moves that there are, for one, and also with the dollar coming back a little bit better bid now. It's also a bit logic that there are pressures on there. I do have another trend line there in gold though, and a level at 19 sharp as well. But for gold, if there's any downturn in the rates because of slowing economies, gold should have an easier task of going back up than silver, because we've been repeating it endlessly. Silver being a metal, an industrial metal, in a bad economic situation, it will have a lot more difficulties to go up despite lower interest rates. So gold may be the better trade there. But yeah, I mean, for the time being, I'm just watching it, those metals. I'm very little inspired by trading gold, because we are going to have like a lot of data coming out. We started with the PMIs today. As you said, we're over the central banks. Now we have to go and look at real data. We have a
Chaps,
massive
I'm
amount
sorry
of
to interrupt.
data next week as well.
I'm stepping off for 2 minutes. Okay, I'll be right back. I'll be right
We
back.
are going to move into end of month, end of quarter. So I'm really watching the game there. But at some stage, if gold goes lower, and I'm looking at 1860s, 1840s or so, I may start to get interested.
Yeah, I think there's a chance we head for a bit of a washout. It wouldn't surprise me if we did, and I said I think it's going to be data driven, and that comes to a point Mike just said, asked, do I believe that euro dollar is still a buy on dip? Well, last week I was looking to buy a dip on all the central banks and whatnot. Was more than happy to try and grab a dip, which I didn't get. What do I think now? I think now we are watching the data, and this is exactly what we're going to be playing with. If we get a really good US PMI later on, if it's really solid, this could be down there trading towards 107s, low 108s, 107s. And what does that make everything that's happened last week with the central banks? It makes it non-existent. It's washing it all out. We're over that hump. This is what we're trading now. Conversely, if the numbers are poor, then I expect this to rally. But that will be, again, more dollar weakness than euro strength. So you have to know from now on what's driving what. If you get a rally in the euro based on dollar weakness because of poor numbers, then you're going to know that we need to play between the data. Next week, we get some European data. It's crap. Well, euro dollar is going to fall again. So we're probably going to have a lot of two-way action, a lot of up and in and a lot of down in, depending on what the data is going to do. And this is just a taster today. Now we're over the central banks of what trading data is all about. So would I buy a dip? I'd buy a technical dip more than a fundamental dip. So no, probably look around the big figures, 108, see what happens if we get down there. This is my old zone, as those of you who've been watching the show long enough know that this for me is a pretty important zone, the 80, 108, 30, 70 zone. We always seem to mess around in there when we get in there. Down to 107, that's the big number. So maybe if we get a move down there, I'd look to maybe pick up some euros depending on what the driver is. But that would be more of a technical trade than a fundamental trade. Whereas last week, I was happy to trade it more on a fundamental central bank trade. So you've got to take your trades and plan your trades to whatever the conditions are. Trade the techs all day long if you want, but also think about the fundamentals with that too. So right now, would I be a dip buyer? Yes, but I need some choice levels. I wouldn't just be jumping in because we've just come off 130, 140 pips. That's not the way I look to trade. Kay, do you want to take the baton?
Of course. Yeah, sure. Let's do a little bit of euro dollar, a bit shorter term for a starter. A little bit of a different look here. I was looking at two trend lines. This is coming back from a much longer time. So I was looking at this yesterday around 109.30. And then I had a bit of a 61.8 there around 109.20, and then this little one. And we had like quite a few touches there over time. And today when it's broken there, so yesterday as well, we had a bit of a touch there. No, on Tuesday, sorry, before we did the last leg up. And that trend line seemed to be holding. Today we're through. And that's going to be my marker, at least, for what's going to happen on the US PMIs. When the European PMIs came out, I did hit the market for a bit, took some off already. I'm only running a small right now, just to see if this 108.90s, call it 109, is going to cap or not in the afternoon. It's anyway going to be a free trade because I'm short from the 119s and having bought some back lower, it's going to be a free trade, whatever. But this is going to be my market today for the rest of the day. 108.90s, 109 the figure on the euro dollar. get back above, then there should be weakness appearing in the dollar side of things. And then speaking about the dollar, we've already mentioned this cable post Bank of England yesterday. We had the Bank of England spike doing the 50 BPs, then that got rejected pretty violently. Then, as we kind of expected, all of us in the show and in our room, this is going to be a bit of a sell the fact, whatever happens. That did happen, and then the dollar picked up steam, and then we came back down in the cable. But we are landing here around anywhere between 126.80 127 is a bit of a support zone for me, and that's going to be the first important one over the US PMIs. If we start to see divergence between what's happening on the European continent and the US continent, we could expect more dollar strength to finish the week, I think. So keep an eye on what's happening, 126.80 figure. On if the US in turn is showing the same weakness as we see in elsewhere, then I reckon that what is it around here, 127.60s again. If we start to break above there, then I wouldn't rule out this thing to go and test the highs again. And that view is supported by what's happening in euro sterling. The euro sterling is coming back down. We try to break out of this that's actually the CPI trade. When it broke back out, the market saw what it had to see, then waiting for Bank of England, and then we had a pretty whoppy, albeit trading in between the goalposts. I highlighted this 86.25.35 the other day, and the high is 35, and then it held this broken support line yesterday. But today we are trying to get back below, and it seems that this is the second round effect of the combination of the UK CPI, the combination of CPI, Bank of England, and today's PMIs. They went also lower in the UK, but to a lesser extent than what's happening in the Eurozone, and that puts me somewhere back into the sell the rallies, sell the rallies camp. If we see somewhere above 86.35, I might give it a try, and try it again, because it does look to me, unless we see a big change in data coming up, that UK is doing a little better than feared, and perhaps a little better than the Eurozone. We especially if you look at the engine room, being Germany in the Eurozone, we've been talking about those data slipping and sliding slowly. And again, today, they largely underwhelmed, right? They are, apart from the composite and the services are now coming off as well, 3 points lower than prior month. The manufacturing sector is deeply in the red. So to me, that in a way is going to continue to find rally sellers on the euro sterling. So that's my view. I'm not going to sell into the hole. I want to first wait what the US PMIs are doing, but I wouldn't be surprised if we put pressure here on this 85.10. Right. What else? Yeah, we were looking at this. Looking at the yen. So the yen, to me, this afternoon, it's relatively straightforward. 142.45.50 on the downside, 143.60 on the top side, and this 143.60 is really the gateway to 145. Yeah. If that 143.60 goes, then I think 145 is just it's an open goal, really, and that would come with stronger US CPIs, and I guess by then we will have very likely heightened alert by the people at the MOF. We will see if this, how the speed is of the dollar yen compared to other dollar pairs as well. So if the dollar yen shoots up, but at the same time cross yen shoots up, that means that the yen is weakening faster than all the rest. Then I do think we may see a bit more MOF talk. On the way down, I think it's 142.45.50 prior highs, 61.8. Here the extension level as well. So that's really your marker there. If this afternoon, let me see quickly what they're expecting for the S&P manufacturing. Yeah, staying below 50. Services, that's probably the one that is going to be the clincher. If services really comes off this afternoon, then I think there's going to be pressure on this 142.5. Now let's look at those euro crosses, because they are very interesting, very, very, very interesting. So let euro yen especially, right? We've seen these weaker PMIs. We showed this trend line, this weekly trend line from the really ultra long term already, and that trend line comes in bang at 155, this weekly trend line. And then if you go to the closer to home, we're also seeing that it was a target zone for this channel, right? And also an extension level of 155 figure 20. This is going to be key to see how we close this week for the euro yen, right? So despite weaker PMIs, we had a big setback. So we blew out of it yesterday. We had a big setback today on the European PMIs, and as per magic, the low of the day is 155.05. So really, I think the market is really watching this 155 in the euro yen. Okay, and sterling yen. Sterling yen. I need to go to the closer one. So sterling yen. Yesterday, when was this? Yeah, I think yesterday, after the Bank of England, we dropped pretty rapidly down back to this mid to low 180s, and it severely bounced from it. We're still struggling a little bit with this 1.618 extension. But if you look at since we've broken up those levels, it's never really looked back, and we're still in a very supportive environment. So keep an eye on what's happening at 182 here, 182.40 for the end of the week. If that goes, then I think 185 is well on the cards. And I don't know what's going to happen before the next Bank of Japan meeting, but if the numbers in the UK don't really come off quickly, I'm not going to stand in front of this train yet to see it come down. Really, we need to get back below 180.5, confirm 180 to retest this break here above 176.5. So for the time being, watch this 182.40. It's an very interesting level. That for the sterling yen. You already covered the metals. Let's have a quick look at what's happening in the crude sphere, because that is still pretty much in. And here we go again. My charts have been changed again. So yeah,
click in and click out again, mate.
Yeah, no, but I've put in the trend line. It's fine. I'll do it later. Support, and we are not that far. We're trading 68.80s. To me, 67, 70, 80 on WTI. Keep an eye on what's happening there. If this support would go, then there's probably another few bucks, perhaps at least one. Why not a few more to do before the end of the week? So that's your support level. Top side, it has to retake 70. We know that. But then here we had this brief blip above this trend line and then got really fiercely rejected. Some people are just looking at this box here really, and we are trying to get back out of it too. So, but it has to go now above 71, 70, 80 to just go into this zone again with a top around 75. But this is looking relatively weak. And if you look at Brent, and that's been weighing on the Norwegian kroner as well. This big like triangle here, it looks to me like there could be some pressure being put on here as well. In the meantime, still very much in a downtrend, right? Still very much in the longer term downtrend. Yesterday we also had the Norges Bank, and so this was the Norges Bank move. We went down to close to support in the euro NOK, but couldn't reach it really. And then we are already much higher because yeah, Norges Bank is hiking, and it's hiking more than expected, but then it's not being helped by gas and oil prices coming down. And even the more interesting one here is dollar Norway. Look at this. It came. We could have been making a head and shoulder, but then the neckline and this support line here, really strong support, and we're already 2.5% higher again. What do I say? 3.5% higher already again. So this, I think we are going to be throwing into the bin because we are through this 1083 already. So very strong bounce here. So that tells me that regardless what the Norges Bank is doing, unless we get a real surprise at the end of next week, if they start to buy Norwegian kroner instead of selling it every day, to me that shows us that the Norwegian kroner is still very far from out of trouble. Quickly on the emerging front, dollar rand. I was long around here and decided to take them off here along this trend line ahead of the US PMIs. A bit early. We are going through. So next stop should be around in the low 1880s. But this thing, unless there's a big accident on the US PMI, should, I think, make its way back and up to 19 sooner or later. I'm just hoping for a slightly weaker PMI without falling out of bed really to try and buy it back here in this zone for the next move higher. I think I'll let mine go a little bit early, but when I see like a 1.5% move in one session, it's very tempting, especially with data in front of us to take profits. So that's what I did, but I'm still lurking at it to re-enter because I think it's pretty impulsive. Yeah, and then dollar China, Ryan already spoke about it. I've got a slightly different look at it. I think there's a bit going on around 723, and the next stop should be in the 725s for me. Strong US PMIs. I think we are going back into this 25-28 zone. It's 1%, and a 1% move is easily done on a developing country currency. Even though the US, I think, has taken them off of the developing countries. So it's starting to be a major currency now. But anyway, dollar China can still move 1% if we get a stronger PMI. If you get a weaker PMI, then it's going to be very interesting if ever we get already down there to see what's happening in the 716.5, 717.5 zone. But in current situation, I think this is going to hold, especially with what's going on the Chinese side of things. Right. Anything else? Anything else? Did anyone talk about any other currency to look at before we go?
The zloty shekel cross. Can you do that?
Come again?
I'm kidding.
Zloty shekel?
Yeah.
Okay. Next week, give me a week or two to prepare. Still, I will do it. So, now, the only thing I wanted to say is that, or repeat really, is that okay? This afternoon's U.S. PMIs, since we've seen the PMIs come off in Europe, it's going to be relatively important to close the week as well, since we're Friday. So expect a few moves this afternoon. And also prepare for next week. Next week is very heavy data, and we do have the ECB forum in Sintra, and we do have the end of the month coming up, the end of a quarter coming up, the end of the half year as well coming up. So I think next week, get some rest over the weekend, because I think next week is going to be a big mover as well. And with that, I give it back to you. Or you take it back instead of...
yeah, and let me see if I can take... I think I know what the problem is. If I can't do it, it's because I'm not actually a host.
And very, very good observation. And end of fiscal year in Australia. So I think it's going to be a very interesting week for the Aussie then in next week as well. So that's going to be great.
Can you end your screen share, mate? I can't take it unless you ended it. I'm going to try. Because there's something I want to just show quickly to, if I can, to RA. If I can't, then I'll leave it. Can you see my screen?
Yes, we can.
Yes, we can.
Yes.
Yay.
Brilliant. So RA just asked a question about Bailey and what's going on. Here's something I want to point out, okay? For all the talk of recessions and stuff going on, this story popped up from the Evening Standard yesterday about how London is rip-roaring. And I've had friends who work in the city saying the same thing, that it's been absolutely massively busy uptown. Now, yes, it's a one-off thing being London. It's a small part of the country, a big part, but things are busy. This, what you can read here, bodes well for retail sales next month. It shows that despite the impending mortgage crisis, the cost of living crisis, every other crisis you want to throw around, the UK has a habit of bucking what the press say and going against the really bad news that everyone keeps telling us we're heading for. Does it mean we're not going to enter the recession or anything like that? No, it doesn't. But it's never as bad as the press makes out. So
can I play devil's advocate just for 1
Go on,
second?
mate.
So the people who go out in Soho and the city and all that, I think we can all agree it's the top 10% of UK people. I think what this is showing is that we have a K-shaped recovery. So the top 10% do very well. The bottom, 70, 80% don't do well. Unfortunately, we're seeing a small subset of the population and of the whole country. So I would take that with a pinch of salt. It's like saying, oh, Canary Wharf is really vibrant. Well, you have all the banks there. So
no, I don't disagree. I don't disagree with that. I can tell you some of my mates aren't in the top 10% of the country, and they're going out and partying away. I see it locally here in Bournemouth.
Okay, that's a different story then.
And stuff like that. Yeah, obviously there's going to be divergences between some towns up north, poorer boroughs, that sort of thing. But what I think the point I'm making is it's never the whole of the UK is heading down the shitter.
I agree.
We've always bucked the trend in versus what the press have been telling us. So there is anecdotal evidence around that things are not going to end up as bad as what some of the press make out. That's the point I'm broadly trying to make here.
No, I agree with that.
Longs either, but always prepared. It can sometimes be a good trade if if a lot of the market, if investors are feeling really nervous and they're trading that way because they think we're heading for problems. And we only had this a few weeks ago before the data started turning better and everyone thinking, oh, the UK isn't as bad. It can switch like a light switch and then the market goes the other way. And that's where the trades come in, because if you see evidence that things aren't as bad as the market's making out, well, you know how to trade it then. You can go the other way. And that's not just for here, that's for Europe, US, wherever you want to look at. Well, yeah, you say that, RA, but I know plenty of teachers who are driving around in fancy cars and they're not at grammar schools, not at private schools. They're at normal schools. So it is swings and roundabouts. And the press are always going to pick out the worst situation. You just go on any BBC News website and you will read 1,000 sob stories and bad news stories. Just quickly, I know time's getting on. Everyone was moaning about the cost of energy months ago when we're heading into winter. Prices going up, can't afford to switch a light bulb on, have to heat my meals with matches and so on and so forth. I drove around the streets and it was like driving through Vegas. Everyone had their Christmas lights up. Everyone was you know, bright and cheery. No one was worrying about they couldn't switch anything on because of energy crisis. As I say, it was like Vegas driving around some of the streets around here. It's never as bad as it is in the press. Always remember that and let the data decide it for you. Anyway, that's it for now. Enough of the lesson. Everybody, thank you very much for coming to the Flow Show this week. I hope we're doing well by you with our analysis and our news. And obviously, a big thank you to Steve for who sits in the background making sure this all ticks along, and Stel and Kay for their valued input as well. Do have a wonderful weekend. Have a wonderful rest of your day trading, and we'll see you all on Monday. Thanks, guys.
Ta-da.
Cheers, guys.